Good afternoon. How are we all doing? Sorry, just checking the microphone works. Couldn't get the microphone working. Seems to be working now. Hello, everybody. Sorry, I'm late. Mumo, afternoon. Robert, Fletch, Fetinet, Soul Trader, Church, Sebastian, Ryan. How we doing? No show, maybe boxed in. Feeling pretty boxed in. Feeling very boxed in. We're starting to panic a bit now. 3 days to go. Haven't even started on the kitchen yet. Anyway, I'm moving house for those of you that don't know. Thinking, what the hell? Boxed in? Right, markets are open. Big sell-off underway on everything on the initial break. So very large sell-off starting. Obviously, we've had no real massive news this morning on the Iran thing. Obviously, there's been bits and pieces flowing through, but nothing particularly exciting that I would say means you've got to panic. So the Iran army, severe consequences await the US was the first thing that we came out with this morning. Military base in Syria was attacked apparently, but nothing from the US about that. So whether it happened or not, we don't know. And how heavily attacked is attacked. Apart from that, nothing much else came out. We've had this this afternoon, just before the market opened, high risk of retaliation. So they're kind of not even saying they've been attacked, and it could be imminent. So that's literally all we've had this morning to do with the flare-up. Obviously, Iran haven't really responded as such yet. So we've had the PMI numbers coming out this morning. The upshot is kind of neutral for the Eurozone. The pound, as you can see, is kind of neutral as well. It was slightly better on the manufacturing. Services came up pretty much on forecast, so it's ever so slightly bullish, but kind of neutral for the Eurozone. So we had one negative, one positive, and a roughly what we thought. We've got the US PMIs coming out in 15 minutes, or 10 minutes after the market's opened. So obviously we are potentially looking for some volatility coming in here. So we'll see what happens with those. Obviously, there's a lot of other stuff coming up this week. We've got CPI numbers coming out. We've got the GDP numbers coming out for the US. And we've also got GDP for the CAD as well. But the main thing this week is the Canadian CPI number. So we've got PMIs, then we've got CAD CPI. We've got the Aussie CPI as well. But that's really your main news of the week is the inflation figures for the CAD apart from these PMIs. So we will see what happens. So long on the Dow, long nearly triggered on the S&P. Not quite. Now I'm triggered. So long S&P, long Dow. Whether this goes or not before the news, we'll have to wait and see. But that rejection sold off fast, but it's come straight back up again. So looks like it's a bit of a whippy open today. We'll see what happens. FX-wise, there's a fair old bit of movement today. Obviously, the Swiss franc is the main thing. The Swiss pumped really hard this morning. I tried, if you were in the live room this morning, to take an aggressive drawdown control position this morning, but I had the EA configured ever so slightly wrong. So what I've actually decided to do is just scale in with multiple positions up here. This is an aggressive position that I've got on to keep that average up nice and close. So what I'm hoping for is a push back down into here so I can close out some of this and do some DD control. So it's starting to pull back. This is obviously a fairly big day today, 225 ADR. We don't get, it's just shy actually, just under 225, but we very rarely get 225 ADR. So obviously this is a safe haven run. Market's starting to get a little bit tetchy. Aussie Swiss down ADR. CAD Swiss not quite as much on the Canadian because of oil. Pound Swiss didn't really move actually today. So yes, it's a difficult one to read at the minute as to what is going on, but it does look like the market's sort of adjusting itself, getting ready for something to happen today, but they're not quite sure what. So my lights went out again. So yeah, we'll see what happens. So there's lots of ADRs. Pretty much half the board has hit ADR today, as you can see. The main movers seem to be the commodity pairs. Aussie and New Zealand's had a really big move today, but there was an awful lot of movement at the open as well. So we had these big wicky candles going in on Aussie New Zealand. You can see there, actually the size of that candle. This one here, can't quite see it. But that candle there, which is the second hour after the open, was 57 pips. ADR is 39. So there was a huge amount of whipsawing came in this morning on that. So it's a little bit difficult, always is on Mondays, to tell whether or not they are actual ADRs, because we tend to get a lot of slippage on the New Zealand Open, and the Aussie and New Zealand pairs obviously get the brunt of that. So, but yeah, lots of opportunities for mean reversions. CAD Swiss obviously was a lovely one this morning, up to ADR, absolutely steaming all day, didn't stop. So I scaled in on the way up. So yeah, that's coming down nicely at the moment, but we need to see what happens next on that one. The weekly range is already done on this, so just bear this in mind. The Swiss yen weekly range is 203. So far today, it's done 220, pretty much. So we've done the entire week's range in a session, basically, during the Asian and London session. So yeah, huge volatility coming in this morning. So will it be interesting to see where we go with this one? RSI extensions, there's loads of those as well. So we went through these this morning. Literally, if you flick over to the 4-hour chart and look through your pairs, there's so much extended. Obviously, with RSI, I love the 4-hour RSI 80-20 levels. They are absolutely brilliant. They're incredibly reliable. So as you can see, when you get above that 80 level on the RSI, you can't see that one. There's one there behind my head as well. So it's that move there, that move there, that move there, that move there, this move here. Yeah. So you had a little one there as well. Obviously the size of the pullback will be dependent on the profit taking that they do, but you know, targeting a 50% retracement on those legs is pretty normal. If it's going to be a shallow pullback, you're looking at a 38% retracement. So if you stick a fib on the leg that has been put in, this is a tricky one, this one, because I would class this as the leg. So if you look at where you're likely to retrace on that leg there, which is kind of the latter half of last week, but it kind of went sideways, didn't it? You're looking at a 38 retracement as coming back down into here. 50% retracement down into there. So a 38 retracement pretty much gets me break even. However, it could be that we're looking at just today's price action, in which case there is your pullback. So a flag break is typically a 38 retracement. Yeah. So if it's just going to be a continuation long, they won't do a full profit take on it. They want to be scaling in. So, be a bit wary, but I mean, it could do anything. All of this movement that we're seeing is based on what's going on with Ukraine and 4 hours, wasn't it? Yeah, with not Ukraine, with Israel, etc. So and Iran, and now the US. So yeah, tricky one to call. But if you go through, there's loads of RSI extensions. Aussie US is nicely extended on the 4 hour as well. You're down at the 20 level there. So there you go. That's that extension. Obviously that one there, which that was more of a Trump move. You had one there. You had one just about there. Touch and go. But, you know, when you get beyond that level, you will get some kind of pullback the vast majority of the time. So looking good. So there's loads of opportunities there. US dollar yen also extended. So the yen got really, really weak with the Swiss franc move. We've got news in 3 minutes. So all of these yens are good opportunities for shorts. Pretty much all the yen pairs. New Zealand dollar yen's not got extended, but pound yen, euro yen, Swiss yen, CAD yen, Aussie yen didn't either. So the Australasian pairs all moving together, obviously, as in they are the Australasian pairs. They all moved during the Asian session. But yeah, US dollar yen 90 on the RSI. So, you know, the 90 level is just a rarity. You know, to get extended on the 4 hour above 90 it takes something pretty special to get to that level and below the 10. You just don't get there very often. But when you do, you typically will get some kind of pullback reaction. But whether or not it's a continuation. But, if you look at the strength of that move there before you got that extension, couple of extra positions and you're out. Same with that one. It took 3 or 4 days, but it came. So this one here where we are now, you're looking at a double top coming up in propulsion of the monthly high, potentially in around about half an ADR from where we are at the moment. So if this one does continue to push for a couple of days, you're going to find resistance there. And after that much of an extension, it's going to want to pull back pretty fast. So good opportunities on a lot of these yen pairs for shorts. Morning, David. Afternoon, even. I see all picture frames in the background have been taken down. Yep. It's very echoey in here. Very echoey. So, yeah. It's weird. I've got my monitors, my desk, obviously, and pretty much nothing else. It's very odd. Morning, Matt. What RSI do you take? It's the 10 on the 4 hour. So on the 4 hour, I use the RSI 10 median. 14 you could use. I used to use the 14. I switched over to the 10 because it's a little bit more responsive. But I'll regret that if we go into a squeeze because it gets you in earlier. But at the minute, obviously, this, since I've changed over to the 10, I haven't really had too much issues. 14, you would just get slightly slower reaction. But so little in it. Really so little in it. So I've taken a little bit of profit today on the pound US dollar. So I took some more profit off. So this one from, I think it's Wednesday, Thursday, Friday. Yeah, so Wednesday last week, that trade, I took that one off and I did some drawdown control on the original trade. So the original trade taken back in May there. So closed out another portion of that. I'd already done some drawdown control on both of these with the profit I took from this one and this one. So I'm just kind of whittling the lot size down, basically, as we get these pushes down, just in case this area holds up, in which case then we're just going to stay range bound, which means that I've got to wait for it to get back up into there, to short it again and wait for it to come back down to take another profit, do more drawdown control and just basically keep washing it out, basically. But that's all I've taken off today. I've got profit on loads of stuff. Oil specifically, I'm looking at. News is out. Just quickly see what the news did. So it's positive US. 0.9 higher differential. Ever so slightly up on the services. So that's probably, oh no, it's broken out to the upside. That's interesting. Okay, so very little reaction to that, as you can see. There's a little bit of a gap, but the market not going crazy on these numbers. News, I think, at the minute is going to be tricky because when, what does PMI matter? What's the Purchasing Managers Index got to do with anything if US goes to war? All these numbers that you're seeing coming out at the moment are all, yeah, okay, in a normal world, this is what we need to pay attention to. But at the minute, it's all about Iran. So I'm not surprised. We didn't get a massive reaction to any of the PMI numbers today. So the market's just really sitting there going, we're not sure what to do next. So oil has pulled back today. We had a gap up situation this morning. So we gapped straight up into last week's high, which is just above the previous week's high, and immediately pulled back within sort of the Asia into the London session to fill that gap. Since we filled the gap, the market has gone sideways. So as you can see, there's the gap fill. So we pulled back in, and then we've pushed back up again, pulled back down, and we are now sitting here. So either that's going to run on those highs, or we're going to come back down and retest the low of Friday, which is your first support. Thursday's low is also there. So obviously this is where we went to as a low point on Thursday before we pushed up and made that weekly high. We came back down and retested this area on Friday. market rejected it. So if we do manage to come down and retest this area today, we've got these two nice support areas here for potential buyers to step in and just hold this range at the minute on oil. So the market obviously wants to go long on oil because it's conflict. Conflict increases oil price. We've got Iran controlling 20% of oil flow at the moment, which means that if they decide to go, screw you world, we're going to stop that channel being used for oil distribution, this is going through the roof. So the market, I think at the moment, is sitting there as I am, positioned long, poised, waiting for the pop. But, you know, it could not happen. The Iranians could just turn around and go, right, we're going to chuck some missiles at some American bases, which they'll obviously defend, and nothing happens. Yeah. It's a little bit like an army turning up with bangers and flashbangs to a full-on assault. They haven't got the air superiority. They haven't got the numbers. They haven't got the advanced weaponry. They can shout and scream as much as they like, but realistically, what they're going to do? Throw rocks? They're not geared up to take on the West, unless it's obviously terrorist activity. So they can hurt everybody by constricting oil. Oil flow is their main weapon. They can turn that oil flow off, and that will affect the price of oil. But from a conflict perspective, they haven't really got a lot that they can do at the moment. So I think the market's kind of sitting around going, this is a 50-50 sort of play at the minute. And you can see from the stock indices as well. We rallied this morning on the European markets. So we had that lovely big strong push up this morning. And then the market sort of came back down again. And we're kind of sitting in these holding patterns at the moment going, want to be bullish, but not really sure. So I think everything's a little bit conflicted at the moment. But we'll see. Market seems like it wants to go long at the moment. So we're up at Globex highs. So we're testing the Globex high at the moment, which is that propulsion move from Friday. So if we break that propulsion, we're going to come and test Friday high. NASDAQ, probably very much the same story. Yeah, so Globex, we're not quite at Globex high yet, but Globex high is the propulsion move from Friday. So again, if we can get that broken, that is Thursday's high, I think. So that was actually, so this is the open of Thursday, which is also happened to be the high on Thursday. And the Dow is at Globex high already. We've just actually pierced it. So again, a little bit different price action on the Dow. It doesn't move the same as the other indices. So we got the high of the day from Friday to watch out for. But obviously this Globex high today could well hold. We need some catalyst really to get this thing moving. It's struggling. It's been struggling for a while. As we know, we're not really making a lot of progress anywhere on the indices, are we? Sideways a lot of the time. Morning, Pleiades. Afternoon even, wherever you are. Mark. David, can you imagine how many people would have stressed out or made bad managing decisions if they were in the trade you're in with the pound US dollar? Since May. You always show us how to manage trades that squeeze us. Yeah. Wait. Literally, it's all you can do. Wait. Spacing is the most important thing. If you space your position correctly, you shouldn't get too heavily squeezed. I mean, obviously, if something is going to go parabolic for weeks, there's nothing you can do about it. You are going to take a lot of heat and you will be taking losses. So, but, you know, it's about holding on and having faith in market structure. Yes, the market will always do the same thing the vast majority of the time. You know, it pushes up and it pulls back. After it's pulled back, it pushes up. Yeah, I mean, it's just what the market has always done and will always do. It's a fear and greed sentiment-based thing, a market. So when you have greed, to realize greed, you need to liquidate. Liquidation makes profit profit takes, and profit takes make price action. Price action is higher highs, higher lows, which is market structure. The market will continuously do that. So as long as you're not getting in here, and all doing this on the way up, you can survive anything pretty much, apart from something catastrophic fundamental, like Trump deciding to put 100 and something % tariffs on China, in which case probably going to hurt. But even that got undone, didn't it? You know, this is the thing. It always gets undone. Whatever he does, whatever anything does in the market, it will panic and react, but it will always undo itself. 50% retracement. Flag break. Yeah. You know, if you were in this, for example, if you got in this, you would have got in somewhere around about there as a short. It wouldn't have played out. So you would have had to add more size. So you'd have got in there, maybe. What's this? 87. I'm on a 4-hour chart, aren't I? Oh, no, you'd have been out on this. I'm on a 4-hour chart. You'd have added. Yeah, I mean, if you're on this, you'd have had one there, out. You've had one out on that. That's an ADR. ADR is only 87 on this. That move is 160. It's 2 ADR. See, nothing pushes far enough without giving you 1 to 2 ADR in a pullback. Whenever you get a pullback, even on a squeeze, usually it's 1 to 2 ADR. Even if it's going to continue to go in the direction it's going, it will give you a couple of ADR. So as long as that average price is within an ADR, you always have an opportunity to exit. And it's just time. It's patience. And you always get paid in one go as well. All of a sudden, everything just suddenly pays. You sit there and you go, this is like pulling teeth. And all of a sudden, you'll just put a 6% day in because the market will just go, right, get out. It's those quarterly, monthly cycles. The market would just pay itself. When it pays itself, you get paid. But you've just got to sit there and wait for them to press their buttons at the end of the day, which is, again, nothing we can control. Pound US dollar, that was a good exit on the pound US, look. So it's Friday's double bottom, basically. Okay, we're at the highs. So we are above Globex high on the S. No, we're not actually. We are just above Globex high. Nasdaq's not there yet. Dow is coming back into this area here, again, where we sold off on Friday. We know the sellers there. I'm just going to protect some of this because to take partials on some of this, just because I've got profit on the morning and I don't want to let the lot go. So I'm going to close out half or 3/4 of the S&P and 3/4 of the Dow, just to get some in the bank, and then we'll see if the Nasdaq can go. I'm just worried about this coming back down from where we are. We're at Globex highs basically. So when you get towards the high of the day, obviously the reason it's called the high of the day is because it's the highest point that there was enough transactions to go long. Therefore, the sellers took control at this point. So when you get to there and you've got profit, if they're going to do it again, kind of makes sense to take the money. So take a partial. It's going to go, it's going to go. But if it's not going to go, I don't want to put the whole morning's profit on the line. Just because of greed. Have you done some studies on how often you would have a pullback of 1 ADR? You can do that with the position trader EA. So if you set the EA up and run a test. So if you run go in the strategy tester with a position trader EA and use, let's go RSI, half an ADR. Let's go 3/4 of an ADR apart. Exit targets off. So exit target as a percentage of ADR 1. So this is basically saying 1 ADR from my average price. So if you set that, see, it's a bit difficult to test because what you're looking at is having multiple positions on. Yeah. So if your average is there and it pulls back 1 ADR, you're not actually getting 1 ADR in profit. So you're probably getting something like 1/4 of an ADR. So if you were to put that at something like 0.25, when you've got multiple positions on, that will get you out roughly on an ADR, 2 ADR of a pullback maybe. Let me put that on RSI 10 4-hour. We'll go 80-20. We will use just a moving average cross entry. And if we're trading the 4-hour, let's get in on the 35. We'll do this on the 30-minute chart. Not sure how many trades this will take. But I mean, I haven't done specific studies on it, just because I see it. I know it happens, but I haven't done any mathematics on it, if you like. See, the trouble is when you get into single trades, this is more of a scalping strategy. It's just going to grab 1/4 of an ADR out of the market every time the market pushes, which is fine because you're going to get a beautiful equity curve. But there you go. There's a multi-push. So that's 4. Well, stop. Okay, so there's 4. From there. So I mean, if you look at, and again, it's very discretionary, isn't it? So are you talking an ADR pullback on what I would class as that leg, or someone else might class as that leg, or someone else might class that as the leg? In which case, I got a 50% retracement. That person got a 61.8 retracement. That person got 100% retracement. But the actual distance that it retraced from high to low there was 166. And Euro US dollar ADR at the moment, obviously, don't know what it was then, is 38. So that retraced 3 ADR in that case. But I mean, statistics don't really matter because the thing with how many times it pulls back 1 ADR, how many times it pulls back 2 ADR is to do with the news at the time. So it all depends on what's happening and what the market's like. And there's too many things that go into it. Statistically speaking, when you get an 80-20 RSI extension, you're unlikely to go more than, we had one there which was 6, I think, wasn't it? You're unlikely to go more than 3 to 4 trades in a position. 1, 2, 3, 4, 5, 6. You've got 6 there. But you'll find most of the time you won't go more than 3 or 4 trades. There's a 5. 1, 2, 3, 4, 5, yeah. But most of them are going to be singles, 2s, 3s, and 4s before you get that pullback, which is enough to get you out. And obviously, if it goes sideways, it doesn't do anything. But that's just Euro US dollar. See, that's not even my strategy. That's using the 30-minute time frame. I'd normally use the 15, but it's all the same thing, isn't it? Really. But that's just a little scalpy strategy. If you went with a higher target on that, like my target of 1 ADR, you'll probably need to do some drawdown control. I'll run it not on visual so that it's faster. but you'll probably find you'd need to do some drawdown control, because the one that got 6 trades on, I'm not sure if that pulled back enough to get 1 ADR from average, but we'll find out. Did, yeah. There you go. So that returned 8%, 8.8% over a year. Whereas the other one returned 2.5%, 3%, but we're trying to scalp a quarter of an ADR. So yeah, I mean, if you're scalping, obviously you're going to have a much higher strike rate and much less trouble. But to answer the question, no, I don't actually know the exact stats, because the stats are going to be skewed. I can give you whatever stats I want, because I can just fine tune to create a statistic. Doesn't mean it's going to happen in the future, does it? What you need to do is what I've just done there is a robustness test. So go, what if I got a quarter of an ADR target? What if I got a 1 ADR target? What if I went for 1.5 ADR as a target, but decided to do drawdown control if we got to a maximum of 8 trades? Yeah, run that. Yeah, so robustness testing is all about trying system parameter permutation tests to go, it doesn't matter what you do, you come out up at the end of it, you just got to be patient and sit through the crap. That's basically what SPP tests with the position trader EA specifically will tell you. There you go. So this is doing drawdown control. Yeah. So this is Mr. Safe Trader going, ooh, don't like the look of this. I'm going to get out of some of this and take some drawdown. He still came up 7.6% up on the year. Mr. Cautious. So if you're Mr. Cautious, you make money. If you're Mr. Super Scalpy and want to get out fast, you make money. If you're Mr. Average and want to get out of an ADR, you make money. What we're interested in is making money, not being right, not being wrong, not looking for, does it do this, that, and the other. We want to test how robust is this method of trading, not should you do this, that, and the other, because you don't know what is coming. I have no idea this year what I should do. I don't know whether this is the right thing or the wrong thing to do with the pound. What I do know is I've banked on it twice. I'm close to my average price and I've got 4 trades on and I'm comfortable. What would you do in the back tester right now? Would you have, if I hadn't have taken that profit there, look. So that's initial trade, 2, 3, 4 out, 4 back on. Sorry, that's 4. That's 5 out, 5 back on, 6 out. If I hadn't have taken that off there, it would have gone down further. So I was in profit at this point. I decided to take a partial. If I'd have left it, it would have moved another 3/4 of an ADR. And I probably could have got out there with a very nice profit and be totally flat on this now. In fact, I probably would have flipped long on that. And I'll be in a long position now. But I know, I think it's going to come down here. You know what I mean? There's no right or wrong, is there? So you can always go out and find statistics, but statistics are going to give you historical information, which has got nothing to do with the future. All the tests that I just did there are based on historical information. Have got nothing to do with the future. This thing could go parabolic now and squeeze for 6 weeks because the US dollar collapses because Iran drops some nuclear bomb they've been hiding away on a base in America. I don't know. But space your trades out in your positions nicely and you will survive for the vast majority. Keep your exposure tight so that you're not overexposing yourself on any individual currency and you'll survive. Just repeating the process. Oil, why are you not going up? Partial just about to be taken on the NASDAQ. So partial taken on the S&P, partial taken on the Dow. I got out too early. It did break. I'm just, again, what's the right thing to do? I'm being super cautious at the moment because of what's going on. In the back tests, I wouldn't be super cautious. I would just let this thing play out. So this is doing exactly what the back test would have done. Today, that and that are not doing what the back test would have done, because the back test would have made twice as much profit. I just am super cautious at the moment because I have no idea what's going on with this conflict. So I'm taking profit when profit's there. That should be reading about 3 grand. It's not, because I did what I did. Discretion. That's about to take profit in a minute. And again, I'm just going to move this down just to guarantee it. If that candle suddenly goes vroom, like that, because we're at the high of the previous day, and there's a sudden massive sell order comes in before that 1 minute candle is finished, that would not take profit for me. I have been caught out like that before, so I do things like this just to be super, super cautious. But again, it's not the right thing, the wrong thing to do. It's just what I'm doing. It's going to give you a different result to the back test. It's going to give you a different result to anything that you do, basically. It is going to close out unless there's a huge candle comes in, which is unlikely. But you never know. Elevated afternoon. So if you want to test that marker, if you want to test that manually, it's quite easy to do manually. The way that I backtest, and I have always backtested in the past, is the trouble is your ADR number is not going to be the same. So the ADR that you've got today is not the ADR in the past. It's going to be not far away usually from what that is. But if you want to do manual backtesting, the best thing to do is to just scroll out on your chart, and every time you see an extension above the 80 level, just mark it, not in the RSI window, mark it on the chart. So there was one there, there was one there, there was one there, one there, one there. Yeah, I haven't marked this one because you're in it from here, look. So if you got in there, you're scaling into that. There's your pullback, there's your exit. You got that one there, you should have got in there, got out there. So just mark them on the chart. So look at that, big drop. Definitely got more than an ADR. This one here, you did not get an ADR out of it. So you entered there, you'd have had to scale in all the way up to there before you got out. In fact, you'd have probably taken another one there. So you'd probably be in 6 to 8 positions, trades on that one. That would probably be a nasty one. However, you'd have to like zoom in and do the actual maths on it. So ADR is 97. If your initial entry, you'd have been out on that because that was 243 pips. That one there, best case you had out of that was 57, so half an ADR. So you're in this for a grand total of 576, which is roughly 576, 97. So that's 5 ADR. So if you're scaling in 3/4 of an ADR apart, you're going to have somewhere in the region of 6 to 7 positions on. One there, maybe one there, one there, one there. Sat around in it for a bit. Wouldn't have got out on that. You'd have had to scale in. You probably would have only got 5 because you wouldn't have been able to get 2 positions on that parabolic run because it wouldn't have given you any signs of strength in the opposite direction. So you'd have got in there and you'd be out on that. The size of that movelet is 448. Which 484. Hang on, what am I talking about here? Yeah, sorry. So that's half an ADR. What am I talking about? $97. So that's 1 ADR. 1, 2. So you'd be out there. You'd be out on it. Basically, you just need to eyeball it. You'll be out. What you want to do when you're backtesting visually is you want to look at opportunities where you would have gone, holy crap, look at the size of that move after I got in. Those are the ones you want to focus in on. So just scroll back through and look for ones where you've got a big extension, but you know, it's a tiny little flag break. But, you know, got in, definitely out. That one, out. I mean, you're not going to find many because 80-20 is just reliable. But let's say you took a 20 on this here. This would be a good one. So you got a 20 extension there. So you'd have been in here, long, no chance of getting out on that. So you'd have scaled in down here and then out on that. That move there was 182, 2 ADR. 2 ADR pullback, which happens to be the usual 50% retracement. What the market does, it's always doing 38s and 50s. It's all it ever does, 38s, 50s, 60, 1/8s, full reversions, A-shaped recoveries, 100% retracements. It's just over and over and over and over and over again. Just go through your charts. You'll get the odd one where it just doesn't work, and that's because all of a sudden the pound has decided to drop its interest rates at the same time as the US dollar decided to put its interest rates up. You're not getting out of that. That thing is going to stretch because the fundamentals have shifted within weeks in the opposite directions, and you will get pulled apart. But it's unlikely for it to happen, and it doesn't happen very often because it's not in either country's interest to diversify their currencies in such a way, because all of a sudden one of them becomes incredibly rich, one of them becomes incredibly poor. The trade relations between the two cannot sustain it. So they have to pull themselves back in line with each other. Otherwise, you just can't do trade. This is the same thing with the US dollar yen. This is why the Japanese had to intervene. The dollar was pushing too hard. They were getting far too aggressive. And the Japanese turned around and went, no, I'm sorry, we cannot do business with you anymore if you keep pushing our currency. And the US went, carry on. So they went and sold all the US bonds. And the US then turned around and went, yep, you're right. Sorry. And now they're trading again quite happily because it was unsustainable. But these squeezes are when there's something that just flicks the opposite direction and the fundamentals shift. You're never going to be able to predict them. You're never going to be able to foresee them. They just happen. And you've got to try and survive them. Swiss yen, US dollar yen's coming down. Swiss yen's coming down nicely. In 4% drawdown on that this morning. Okay, partial taken on the NASDAQ. All locked in, trailing stops. So trailers locked in on all. That's break even at the moment on the S&P. I always have a different trailer on that to give it an opportunity to breathe a little bit more. By the way, what are your stats on ORB? And are there times where you don't take ORB? Yeah, I don't know what stats are. I'd have to do an analysis on it. There are times when I don't take SIH. What I've decided to do is run the SIH on low risk, because it's the same strategy really. So where this will continuously make small profit, the ORB will often make the same profit. So I've decided to scale it back a little bit. And this is just running on a small account, making small amounts. I don't really turn it off, but there are days where I don't run it at all, run any of them at all, because I just don't like the look of the market, or I don't like the look of what's going on, or we've got a big news event. You know, you see me in here in the live room sometimes just not trading it because it's just not right. But the edge is there. The edge is there with the strategy if you let the edge play out. And this is the thing that people don't do. They don't let edges play out long term. They see a strategy, they try it, and it goes through a losing run of 5 days in a row, and they scrap it. If you go and back test the ORB strategy, you will find it has more than 5 days in a row losing. I think there's 17 trades in a row is the max loss I've had on it. 17 trades in a row, all losers. Yeah. That's what's happened in the past. Why won't that happen again in the future? It will. It's part of the equity curve. It was the bit that went like that. It's going to happen. It's bear market. It's a range bound market. Just not going to make money. But then the days like this are going to get that back. You have to sit through that to get that. It's a breakout strategy. It has a strike rate of around about 30 to 40%. Because it's a breakout strategy and that's what they have. Same as trend strategies. You're never going to get a breakout strategy that's got a strike rate of 60, 70%. It just doesn't exist because most breakouts fail because the market spends most of its time in ranges. So if it spends 80% of its time ranging, you're going to lose 80% of the time if you are trying to take breakouts. Every time it gets there and it gets back to it, you're going to try and break it and it's not going to work. And then you'll try and break it again. Then you'll try and break it again. By the time it actually breaks, you're going to make back 3R, which is what you lost, which is why most people's P&Ls go like that. They look like a range. What it is, isn't it? It's trading. Do you know if there is a scientific reason why 50% retracements tend to be good targets for the reasonable distance? Or is this a reasonable distance tendency? So Fibonacci ratios are based on lots and lots of things in nature, in everything. Pound CAD's just hit ADR. Weak Canadian dollar. Oil is weakening really badly. Don't like the look of this oil at all. We just hit ADR on oil. I'm going to watch this a little bit closer. But Fibonacci retracements are a mathematical mathematical equation, basically. And lots of things in the world work on fibs. It's like the 80-20 rule. No one can really explain why the 80-20 rule works. It just does. Yeah, I mean, there obviously is a mathematical equation probably for it. But with fibs, basically, and with specifically with forex markets, which is why the Fibonacci strategies are so popular in forex, it's to do with the distribution of orders through the banks and institutions. So if you are driving price in a direction, you will be allocating a certain amount of capital to make that move happen. And you'll have an allocation of capital that you will take profit on before adding more into the move. Yeah. So banks and institutions can't just dump 200 million long because they need 200 million shorts to be able to fill the order. So you move the market up to price levels where you complete your order and then you stop and you take profit on the percentage that you need to get out of to do whatever needs to be done for the portfolio and the direction. The client orders, the commercial orders, the speculative orders will all be liquidated to make money. So it's just a naturally occurring phenomenon that banks and institutions create in the way that they action price orders. Yeah. So if you're a bank and you dump 200 million long and it manages to push price up to here, you'll take 100 million off, take profit on it, take half. Just what they do. But they don't always do that because you've also got all the other banks having their portfolios actioned as well. But the only way a bank can get an order long is if a bank takes the order short. So by definition, when it's pushed in a certain direction for a certain period of time, they will have to stop because there will not be any orders to take in the opposite direction. Therefore, they will let those orders push back in that direction. Then you get to a point where there is a equal weight of orders where you tend to get stuck. And then one of the market participants will then drive in the other direction. So you'll either get a retracement like this, which is a shallow pullback, where you're getting all of your orders fulfilled really, really quick and you can carry on with the move, or you won't and you'll have to reach further to get the rest of those orders off. Or the banks coming this way will want to push really hard to get to a certain price point to get their orders executed, and then they will take a portion of their orders off. So if they're pushing down, they will take profit in that direction. But it's just maths at the end of the day. The whole thing is a market. Market has to have two participants of equal measure. If there is a price point there that requires $100 to be transacted, $100 of the shorts will be taken off, $100 of the longs will be taken off, and then either they will have to step up to the next price point or they will have to step down to the next price point to make the next transaction happen. That is a tick. It's just naturally occurring price movement. But if you assume the worst case scenario when you're in a trade, that what's going to happen is you'll get a 50% retracement. You'll be right most of the time. Yeah. So when you get into a long position when something's pushing down, this obviously hasn't got extended today, but let's say, for example, that was an RSI extension on the hourly, you're pretty safe targeting a 50% pullback. But worst case scenario, target a 38% pullback. Best case scenario, target a V-shaped recovery. You'll never know which one's going to happen because you don't know what the weight of orders is at any point of the day, and you don't know what new orders are going to be coming in. If Trump turns around and says, we have an agreement with Iran and they will stop producing nuclear weapons, oil is going to go through the floor. If Iran turn around and go, we have just hit a US base and we are stopping supply through the whatever canal, therefore there will be no more oil flow through to Europe through us, this will go through the roof. But if nothing of that happens, the market will just ebb and flow. And banks will push and pull order flow through the market. And they take profit, they add. They take profit, they add. They take profit, they add. And that's all it ever does. And this is what market structure is. It's the highs, the lows, the lower highs, the lower lows. Yeah, and you'll always find these will be 38, 50, or 61.8. Roughly. Never exact. It's never exact. And this is why people that learn fib always dump it. People that learn Elliott wave always dump it because they're looking for the exact measurements. There is no such thing as exact in this market. That was a beautiful pullback. But it all happened within 1 hour. And it's not to the exact price ratio that it mathematically says in the manual. Hang on a minute, that didn't pull back to exactly 38.1. No, it didn't. It's rough. It's all rough. But, you know, look historically. There's a 61.8 retracement there. That's a 71.9 actually. I don't need to measure it because I can see it because you see it all the time. It's 50% retracement. 71.9 retracement. That's a 38. That's a flag break. Just what it does. But the speed it gets there and how many days it takes, how many hours it takes, exactly where it gets to, it's all rough. So if you take fibs and combine them with propulsion gaps, oil's probably not the best thing to look at. Neither is the Swiss franc at the moment. But if you combine Fibonacci with propulsion, it's a 61.8 retracement, that leg, but it's more of a range, really. Probably better off looking at that move there. Yeah. So if you look at that move there, that's a 50% retracement. If you look at the entire leg there, that's a 50% retracement. If you look at that entire leg there, that's a 50% retracement. But whichever way you look at it, whether you look at that being a leg, that being a leg, that being a leg, that being a leg, or that being a leg, you're always going to find roughly the same thing in a normal market, because that's what market structure is. If I'm buying, I make a new high. When it pulls back, I add more to make a new high. When it pulls back, I add more to make a new high. When it pulls back, I add more to attempt to make a new high, unless the sellers overpower me, in which case they will make a new low. Then I will pull back to make a new low. Then I will pull back to make a new low. Then I will pull back unless the buyers overpower me to make a new high. Then I will pull back to make a new high. It's market structure. All it does. Go in history. Look at any chart. It's all it does. It's all it ever will do, because it's a buying and selling market with a binary outcome. Therefore, it has to have equilibrium, which means it has to go up by a percentage and pull back by a percentage. Then it is offside, and it has to do one of those things again. Just will repeat itself, because unless there is balance in the market, one bank will be losing a fortune, another bank will be making a fortune. So they balance it out. This is why we have propulsion gaps on the chart. They show you where the bank orders are. So if you push and you get to a high and it suddenly starts coming down, stick a fib on it and see if there's a propulsion gap at either 38, 50 or 61.8. In this case, it was at 50. They bought that propulsion gap. Yeah. And they pushed higher. Bought that propulsion gap. Pushed higher. They bought that propulsion gap, but they got overpowered. Yeah. So you see what I mean? It's never exact. It's never exact. But if you're in a position like my pound US, look at my first exit here on this. That propulsion gap was live at the time I got out. The reason I got out was because we hit that propulsion gap. Yeah. So I knew it was also a double bottom weekly, but if we were going to continue, I needed to get out of some of it there, because the likelihood is either they are going to double bottom that and go back up, or they're going to do that. At the moment, we're just doing this. We're sideways, aren't we? They can't decide where to go. But all these little movements in here will have retracements of some kind in them, every single candlestick. But people go down to silly time frames with this. They go down onto hourly charts and look at 5-minute Fibonacci levels and all this sort of stuff, which, it will work as well. Look at this pound US dollar. If you want to sell it right now on this massive shooting star that's going in at the top there, 10 seconds. Beautiful. So where you want to target on this? You should be able to see it. Sticks out like a sore thumb. 38 retracement. There's also a 61.8 retracement. So it's either going to hit that or it's going to hit that. It might do that. But if you want to go short right now with a stop above that high, get out here safe. Because this is where the buyers broke the high. This is where they will add more size. And it happens to be one of those numbers that's just magic. The best thing is literally market structure. This is why this is why I'm called what I'm called. It's all to do with mathematical equation. It's to do with Fibonacci ratios. Market structure is Fib. It is Elliott wave. It's all the same stuff. But Fib and Elliott wave is overcomplication of something going down and coming back up again, because it's trying to put a mathematical equation onto something that is random. This price action is random. It will go to a distance which is random based on the volume of orders coming back at it. You're swimming against the tide always. There's always a bigger fish that's always going to push you the other way. So if you see where the big fish are, and when you start getting back to those areas, you know that that fish is likely going to be bigger than you. You know what to do. But market structure, when you get a high and a low, is always going to put in a lower high. In that case, it was there before it came down. But the textbook will say you short it there. You will put in a lower low. You didn't. You put in a higher low. What that caused was a symmetrical triangle break to the upside. So everyone started buying it, but they didn't realize it was just a pullback on that leg there that was deeper than the first one, because there was more buyers in the market at that day than there was the day before. But the guys that started that move managed to hold that. But there's no textbook that can show you that pattern because it's random. So this is why position trading works so well, because I don't have to be accurate at all. I have to be in and out of the market when the market moves up and down. And the one thing I know for sure is it's going to move up and down. I have no idea when it's going anywhere. I have no idea what level it's going to. I can guesstimate, but I can plan for best case and worst case scenario using market structure. This is bearish at the moment. Got high, a low, a lower high, a lower low, a lower high, a lower low. Now we've put in a higher high and a lower low. It's an expanding wedge. Yeah. So in theory, we should come back now and test that area before dropping to the downside, because this is rolling over. That's my theory there. It could be completely wrong. I've got a 50% chance of being right, because it's either going to do that or it's going to do that. I can guesstimate as much as I like, but I know I've got these guys on my side. Yeah, this is pulling back at the moment on that down leg. It's gone way beyond 61.8. Yeah, so this is completely invalid Fibonacci. But if this thing now puts that in and then does that and that and that, can call it roughly a 68. It just got a bit further than before. You know, this is the problem. Everybody wants it to be exact. Doesn't match my rules exactly. I'm not going to take it. I've got hope in hell. If you have a rule book that's that tight that you can't open it and make few adjustments to it, it's just not going to work, is it? New Zealand dollar, US dollar, nice spike. On the 4. Yeah. There's that 80-20. That's an ADR reversal. So those buyers there, they took control, added. Now we're coming back down again. So you've got your reversal alert, market structure, breaks short. We're pulling back to where? $61.8 would be that low. Yeah. So again, you know, the support resistance will typically be, as in this case, it will typically be a previous support. So support, when it's broken, turns into resistance. Just mathematically normally lines up with a fib. It isn't bouncing because of the fib. This is the thing that gets my goat in the forums and things. It's like, hey, did you see that 61.8 bounce? It was perfect. It was to the pip. It was just a fluke. It didn't bounce to the pip because the markets were sitting there going, wait, sell 200 million, because it got to the 61.8 retracement. Just happens to coincidentally line up with mathematics. Yeah. But what it was everybody that was buying there was long. They all had their stop and reverse orders here. When it came down and broke down through that level, their stop and reverse orders triggered them short. Now they're short along with those guys. You've got twice as many shorts in the market. When you get back to this point, it's going to find it hard to get through there because these guys are short. These guys that were long are now short as well. So what do you think it's going to do on the next leg? Yeah, where's it going to bounce? The monthly low. Because that's what it did last time. Unless you have a reason for that not to happen, assume that is going to happen. Yeah. And if it happens, yeah, put a line, a fib on it, and look for where it's likely to bounce back to before it crashes through that bottom or drives up to that high, because that's what's going to happen. It's either going to test that high or it's going to slam through and break that level. Guaranteed one of those two things is going to happen. Because it has to happen. Because it cannot stay in this range forever. It has to break out. Your job is to decide whether you're a bull or a bear. You've got no idea whether you're right or wrong. But if you get down to here and you long it, be prepared to scale in down to here. Because there's absolutely nothing to stop that price until we get to this point here. Because this is where the last batch of buyers were. And they're probably out, to be honest. So market structure could be completely different here, and this is irrelevant because this is all Trump. But you don't know, do you? No one knows. So you just get in and you use whatever tools you've got available to try and figure out what the hell's going on. But no one can give you an exact, this is what's going to happen. But you know that when you get an 80-20 extension, the probabilities are the market is going to pull back because it's exhausted. The buyers are not going to find any more sellers. They've had them all. This is why we've moved this fast. The relative strength is so strong because there's been a load of people with the opposite opinion. They will take that portion off. And then they will start their next leg and they will take that portion off. They will start their next leg and they will take that portion off until they do not need to do this anymore. And then they will let these guys go and they will go with them. And then we go back the other way. But, you know, all these sort of theories about the 3 pushes, you know, so it's done 1, it's done 2, it's done 3. So this is it. So now we're going to get a W pattern and come back up again. Sometimes that works. Sometimes it goes 4, sometimes it goes 5. I used the Steve Malraux 3 push strategy for years. Well, I followed it for years. I kept an eye on it for years and I threw it away because I was like, no, but Steve Malraux said it's going to do it 3 times and then it's going to reverse. It did it 4 times. I lost money. Steve Malraux doesn't know what he's talking about. Steve Malraux didn't say for a guaranteed fact it's going to do it 3 times every time. He said it's quite common. It is. It's also quite common to flip a coin and get a head or a tail. all the same stuff. It's random. So it's this is a solid way to measure market structure. Yeah. It's a really good way. If you so using the reversal alert indicator, what this does is it signals a shift in structure. Yeah. So this tells you that basically the sellers have now taken control. So when you get a reversal alert, if you stick a fib at the top there and wait for some kind of bull candle to come back your way, yeah, like that, you know that that's the low. You know that that's your old high. So that is where you're going to stick your fib on. And if you're going to assume that the sellers that took control and caused that reversal alert to work are going to add into their trade, it will be on a retest of the low that got broken, which will cause typically a propulsion gap. So you can either use that low as your 50% retracement, or there'll be a propulsion gap as your 50% retracement. But use whatever you want. You can use a fib, you can use the reversal alert, or you can use a propulsion gap indicator. All three are always going to line up most of the time. Yeah, that break is roughly 50% retracement. You just, in this case, you don't have a propulsion gap there. But if you had a propulsion gap there, you've got confluence of 50% retracement, propulsion gap, and support break. And then when you get back there on the 5-minute chart, wait for a reversal alert on the lower time frame, jump in. Because that is how you're going to pick the absolute high. But don't blame me if it decides to pull back into that propulsion gap and do a 71.9 retracement before it puts a new leg in. That's also an option. And so is a V-shaped recovery, because it's hit this propulsion gap, which is these guys standing here that want to buy it. And now it's going to go into a range. One of those is going to happen. But the problem is everybody's trying to predict exactly what is going to happen. And this is why you will get stopped out, because if there's 3 or 4 different scenarios that are going to play out, yeah. So let's say it either does that and that, or it does that and that, or it does that and that, or it just does a little flag break and drops. I have a 25% chance of getting that right, which means I have a 75% chance of getting that wrong. So if I just buy it here and see what it does, I can then take some money. And if it doesn't do what I think it's going to do, I can change my price and get out later. Because if it does that and I'm wrong, and I add a trade here and a trade here, my average price is there. So now I measure my fib like this, and I wait for a 50% retracement, and I just take both of those trades off in profit. Or I could take a 38% retracement and take this one off in profit and take this one off in break even. But what have I lost? Nothing. Because I didn't use a stop. Because I don't know what the market structure is going to be from this point onwards. It's that or that. I have no clue. But what I do know is I know what will happen. So I can plan for it. If I get in with 1% risk, 1% risk, and 1% risk, by the time I get down to here, I'm going to be in 3.5% of drawdown, and I'm going to be panicking. That's not how you're going to make money. If you're scared, you're over leveraged. If you're in it and you couldn't give a monkeys, you're in it and you couldn't give a monkeys. But I'm still making money. I'm just not trying to be right. That's the big difference. And this is the light bulb moment for most people, is they go, well, if I just hit the button and wait, it will work. It will, because this thing goes up and down. Occasionally it will go up and it won't stop going up. And there's nothing you can do about that. And you will take losses. You'll take a 9%, a 10% loss, a 6% loss. You'll take some loss. You'll just go, I can't handle this anymore, and you'll get out. Yeah. In the same way as you will lose 100 times if you put a stop loss in the market, you will lose every now and again on squeeze. But this majority of the time, 9 months out of 11, out of 12, depending on summer trading, you will make money because you're not trying to get it right. You're just trying to make money. And that means just extracting market movement, money out of market movement. And market movement is always going to happen. If you sold that, you were wrong. So you added into it until you were right. But you had no idea. What you thought was going to happen was that. What actually happened was that. Totally wrong, but totally right. I'm such a dream and hope destroyer and party pooper. So you are saying there is no Holy Grail? I wish. Why the heck am I in your room? You found the Holy Grail, you just don't realize it. Carry on doing this for 6 months. And when you suddenly go, hang on a minute, I haven't blown an account. Hopefully the Holy Grail penny will drop. But equally, don't. I traded with stops for a long time, yeah, and I became more than break even. But the thing that is different is frustration level. I don't get frustrated with this because there's nothing to frustrate you, is there? If I short this now and I'm wrong, I don't care. If I short this now and I get stopped out, I care. And then I'll try and go, right, okay, well, that's breaking out. So this propulsion gap that's being drawn here, I'll wait for it to get back into there and I'll buy it. And then it will come down here and stop me out and I'll get cross. So that's 2 trades it owes me. So I need a 3R just to get a profit now. If the next one goes down the pan, I'm going to need a 3R to break even. I'm immediately on the back foot. I'm immediately trading erratically and immediately cross. That's the change that position trading makes. It removes stress. It removes the ability or the need to be right and wrong, which means that average Joe Blogs can do this. 1 or 2% of the entire population of traders can trade a 5-minute chart and make consistent profit for 3 to 6 months. And they will at some point burn out. Yeah, that's not the 90%, is it? They don't do that. If that was the case, it would be less. It would be more than 0.3% of people that take a proper valuation get paid. That's the statistic. Less than 0.5% of people that do evaluations actually get to payout. 10,000 people trading at top step. 25 of them on that ladder. 25. And the ones at the bottom there are hardly making any money. So if there's 10,000 people trading on prop and there's 25 of them making money, do the maths. I am already experiencing this. Good. Right, I'll stop waffling now. So yeah, still in stuff. I've got a feeling this oil trade's going to go wrong. It's not. I was expecting a breakout of the highs today. We haven't got it. Stopped out in profit on the Dow. So the Dow has pulled back 50%. NASDAQ and S&P holding up. So, if you're going bull here, and this is the thing, with the fib, with, oh God, it's yellow. I hate that. Why did they make the default fib yellow? It's because people trade with black charts, isn't it? So, that's not the right level. Look at that. To the pip. Oh, I haven't got it in the right place. That's my bad. This is the thing that people get wrong with the fibs and this is where I went wrong with the fib. I would be going like, right, okay, well, I'll buy it at 38. If that doesn't work, I'll buy it at 50. If that doesn't work, I'll buy it at 61.8 and I'll put my stop below 71.9. So, and it would work most of the time. But if you buy it at 50 and put your stop at 61.8 and it doesn't work, you're going to get stopped out. So what's that immediate want you to do? Well, that wasn't the level, so it's obviously this one, and you buy it again. And then it goes down to there and you're like, oh, that wasn't the one either. Okay, so I'll wait until it does that and then I'll short it. And then it does that. So you lose 3 times because you're trying to guess which line the market will bounce at. The market doesn't have lines. You put lines. This has been manufactured by human. Yeah, not by market. So, this is where everyone goes wrong in fib. They assume that one of these has got to work. It hasn't got to do anything. A lot of the time, it will bounce roughly somewhere around. But, you'll see it also. You'll go long here, and all of a sudden, then it will just spike down and put in a lovely hammer. And you'll be like, I was right, but you got stopped out, but I was right. Yeah, see, it did only pull down to 61.8. It took me, and then it went. I was right. You lost money. Doesn't work, does it? If there was a load of fib traders around that were making fortunes, they'd all be out there. But no one talks about fibs because everybody's tried them and they don't work because they try to use them in the wrong way. I use them for targeting. Yeah, that's the best thing to use them for. Not for getting in, targeting. Where's it going? Propulsion gaps. This looks like it's going to roll over. So I'm going to get out of the NASDAQ and take that off. I'm going to cancel pendings. because if this collapses, I don't want to get in it. Yeah, I'm just going to hold this S&P for a runner today. So if we are going to continue, I don't like the way this Dow's coming down really fast, and we are stalled out completely and looking like we're rolling over. So I'm going to leave this one running, and just in case Iran does something or Trump does something and we just suddenly get a flyer, then I'll leave that on. Otherwise, that one will stop out a break even, or it'll just flip flop around and it'll get closed out end of day. But yeah, I'm not convinced by this market today. It's there's a lot of movement, but it's a little bit odd directional wise, isn't it? So just to clarify, your combined profit target on multiple positions is 1 ADR distance from the average price. Yes, normally. So that's what I have the EA set up to do. So I have the EA set up at, I've just changed it, right? So normally that is set to 1 ADR. At the moment, I've just set it to 2 ADR because what I don't want to do is have a massive spike in the market in my favor because of a conflict event and take 1 ADR when I could have got 2 out of it. So I've moved it, but normally that would be set to 1. But that is also a caveat that I will decide where I get out based on what I'm seeing on my charts. So, you know, this here is working at the moment, pulling back nicely, but if it doesn't, I'm going to need to make decisions on it. The pound US dollar is flying back up again. What's in profit? Aussie New Zealand, but that's only a single. So, you know, that's pulling back at the moment. So if I see a level that I think looks good, I might close it out. But typically I will target 1 ADR from average. So if I get into a single trade like that and it moves 1 ADR, I'm in. If I get in a single, take a second, average is there and it moves 1 ADR, I'm out. Again, test. Go in the back tester, do what I've just done, which is exactly what we've done. I set that to 0.25. I set it to 1 and I set it to 1.5. We had 3 different results, all profitable. Does it matter where your target is? No, I've just proven it. Trading on the Euro US dollar for the last 12 months, it doesn't matter what you'd have targeted, they all would have worked. You would have made a lot more money on the 1.5s, but equally, you would have taken more trades if you'd taken a quarter of an ADR as a target. No right or wrong. This is the thing that's important. There is different settings. There isn't a right setting or a wrong setting because you cannot see the future. You do not know what the price action is going to be. Therefore, you do not know what you need to target. Target what you want when you see it to make money. And if you think, I'm going to close that oil out now and take the whole lot of it and take half of the Euro CAD off because I don't like it, do it. Is it the right or wrong thing to do? No idea. Because unless you know what's happening tomorrow, you cannot make a decision today that is correct. And no one knows what's happening tomorrow. So you just have to target something. If you target that propulsion gap now and get out because it's coming back through it, that's either the right thing or the wrong thing to do. If this thing comes down to here by the end of the day, it was the right thing to do. If it gets to that propulsion gap, fills it and bounces up to there, it's the wrong thing to do. What you are doing, though, is taking money. No one can tell you what to do. Not me specifically. Or anybody. I think this is my weak point at the moment. I should do more back testing, but I'm not confident with adding the settings. So just go, it's, you know, there's no, you can't just suddenly go, I'm an expert. You've got to play with stuff. You've got to learn stuff in everything that you do. You know, I'm building out a statistical algorithm using AI at the moment. Never done it in my life. I'm learning a lot fast. I'm learning what it's capable of doing fast. But I'm learning it, and I'm learning by doing, and that is the best thing. If you learn by doing, you will learn. And that's the key thing. So you got to spend time in the back tester. Watch it. Just watch the thing, obviously in visual mode, but watch it play out. You're going to learn a lot more watching this go up and down. I'm watching weeks and weeks fly past. proving concept. So this gives me confidence in strategy because I'm seeing it happen over and over again. But that trade there that's just played out took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 days. It flew past in 3 seconds. But in the real world, you sat there for 17 days. Yeah, your average price was there. So for 1, 2, 3, 4, 5, 6, 7, 8, 9 of those 17 days, you were in drawdown. Then you got into profit for 1, 2, 3, 4, 5 days, and then you went into drawdown again. Then you went back to profit again. Then you went to drawdown again, and then you went to profit and you hit your target. But in the backtester, you can see, oh, I might be in it for 2 or 3 weeks. The next one, I might be in it for 2 or 3 weeks. So when you're sitting there 6 days into a trade, you're not panicking because you've seen that you're going to be in there for 2 or 3 weeks sometimes. Week and a half, 2 weeks, 3 days. Couple of weeks, week, 2 weeks, 3 weeks, back to break even. Shall I take it? Shall I take it? No. Shall I take it? No. Shall I take it? I don't know what to do. I could have got out of that 6 or 7 days. I could have got out of it in profit, but you let it run. You would have got out there, probably. Or would you? Don't know. Because you don't know what your situation is going to be when you're in it. This is the thing. Drawdown control. Oh, this is a squeeze. It's going far too fast. I need to do some drawdown control, get my average down. I'm sitting in it now for month and a half. In a squeeze, more drawdown control. Oh, I'm just hemorrhaging money. But this will pop back up. Because on a daily time frame, we're waiting for the 50% retracement to come. And it will. It just takes forever. Yeah, this is taking months. Out. But this, look at what I'm in at the moment. ADR on the pound US, 125. I'm going to break even this Aussie New Zealand. This is really selling off hard. But the pound US dollar, I've been in this since May. 12th of May. We're at the end of June. 6 weeks. I've banked twice on it, but I'm still in it 6 weeks later. Do I have a specific members section on backtesting the position trader EA? No, because it's just an EA like any other. The backtesting is all in the members stream. If you go into the members section, these down here, strategy development, the very first one back here, backtesting basics for development, quant analyzer essentials, robustness testing and optimization best practices, all of this stuff to do with strategy development, that will give you the basics of what you do in the tester. And you just get used to it. It doesn't matter what the EA is. The EA is irrelevant. The testing process is important. So watch those. But there's nothing specific on the position trader EA. If you understand the strategy, then there's nothing much else you can really watch. And the position trader EA has its own videos which explain what all the inputs do. So as long as you understand what the inputs do, that's all you need. So that's a short version, which is about 4 minutes. And then you've got the long version here, which is 23 minutes. Then you've got an explanation of each of the strategies as well. But I can only talk about the inputs and what the inputs do. How you put the inputs together is up to you. All the position trader EA does is pretty much trade all the strategies in the strategy section. You can trade most of these strategies that are in here, which is the basic position trading strategies that I teach in the bootcamp. But there's a billion variations of it that you can do. And you just test and see what you like, because everybody's different. Some people like that trade that lasted for 3 months, they'd be like, not interested. Then don't do it. Don't trade that way. Trade with a maximum stop loss of 5% on the account and take a hit every time you get to 5% and then start again. Yeah, you can do that because the position trader EA has that facility in there to be able to do that. But there is no right or wrong in trading. This is what I've learned over a long time, and trading a lot of different strategies, doing a lot of different courses, doing a lot of different EAs. Everything comes down to the same thing. You will always make money if you let the market move. If you use some kind of stop loss mechanism, you will find it hard to make money, because the market is random in its movement based on banking institutional requirements placed by businesses and corporates around the world. And it's an ever-changing, fluid thing that cannot be quantified with any kind of fixed parameters. So you have to be flexible with the market. The best way to do that is to do what the banks do, which is to scale in and out of market movement. They do not use stop losses. They don't get in and go, we'll put a stop loss down here, which is what? 25 grand. Okay, so if it drops a little bit, we're going to lose 25 grand. Are you mental? No. If it drops down there, we'll get the market makers to buy a crap load of it and push it up again. That's what they do. So if they're doing that and you hop on the same way, when they do it, you will make money as well. You just need to understand how they move. And that is all that is observation. Looking at what they always do. It just does the same thing, up and down and up and down. Sometimes it goes down much longer than other times. And these are the ones where you have to make a judgment call on whether or not you're going to stay the course, whether or not you're going to close part of it out, whether or not you're going to just, everything you bank, you're just going to put the whole lot into there to get rid of the position, what you're going to do with it. But, it will always do that. This is coming down, right? Somewhere here or here at some point. It might do this for the next 3 to 4 weeks. I don't know. But if it pushes up further, it's got even further to come. And the more stretched that elastic band gets, the faster that ping back is going to be. As long as you haven't got a Trump in there, which we have at the moment, and a conflict, which we have at the moment. Yeah, and this is the things that catch you out. Something's changed. The war could last 2 years, and we are prepared for that. So Iran basically going to war. It should be good for oil. Bowman would support a cut in July if inflation remains subdued. So potential cuts coming on the US dollar. So this is why the market is reversing now, because we've had a change in fundamentals. But look at how little impact I'm paying attention to this, because I haven't got a choice. I am short this. If the dollar is now going to weaken because they're going to drop interest rates, I haven't got a choice. I can't go, actually, no, I'm not short anymore. I am short. So now I've got to deal with it. So when it gets up to here, I'm going to need to add more, move this line up, wait for that to drop down. What it will do for me now is I will probably be more bearish on the US, which means I will probably get out of this sooner with less profit. I will change my focus. But you have to change and be fluid with the way that the market is changing and be fluid. This morning, the Fed weren't dropping interest rates in July. Now they are. Bearish US. So it's going to be bullish for stock markets and bearish for US dollar. That's changed. Powell hasn't said anything yet. Powell might come out and go, inflation is not really where we want it to be. So I would favor a cut in August or September. And it's back up here again. But that's what it does all the time, isn't it? Goes up and down. Knee-jerk reaction is not long-term, necessarily. Down, up, down, up, down, up. 61.8. Same thing over and over. It's just not going to do it in the way you want it to do. What we want is to press the button and it go, no problem. No, doesn't do that, does it? I press the buy button and it goes up. When does that ever happen? If you're right every time, there's something very wrong. You're either a time traveler or incredibly lucky. You want to check the bottom of your shoes. Right, I'll leave it there today. I'll be back on Wednesday. It's my last stream on Wednesday, morning and afternoon. I'm then off for a week. So I won't be around next week very much because I'm doing other stuff. Can you quickly share which FX instruments you use to prevent correlation? It's the ones in the top left there. So everything above oil, basically. Aussie New Zealand, Aussie US, Swiss yen, although I'm kind of favouring not having a yen pair at the moment. Euro CAD, Euro Swiss, Euro pound, and pound US dollar. So I've got triple exposure on the euro, but one of those is with a safe haven. So that will move independently of the other two euro pairs. Double Aussie exposure, double US exposure, and double pound exposure, euro pound and pound US. So that keeps the exposure fairly tight, and they are non-correlated at the moment, but the correlation matrix will change. So these are typically uncorrelated because you've got commodities in there, you've got services in there, you've got some dollar in there, you've got some safe haven in there. So it's very nicely diversified in the respect of most of the time when something else is pushing, another thing will usually be pulling. But, you know, it is what it is. You never know. But this means you hardly can have some trades. I beg to differ. I've got tons of trades on. If they don't go over the 80 or the 20 on the RSI, then no, it won't take trades. But I'm not trading that strategy, 80-20 RSI. I'm just trading. I'm getting in when I fancy getting in. Yeah. So my trades are being taken when I like the look of stuff. I'm not. If there's an RSI extension above 80-20, I'm going to get in. I might look at an hourly chart and go, I like that, and take that. I might like the look of that and take that because it's a double bottom bounce, in which case then that wouldn't have worked. It probably wouldn't have got out on that, so I'd have scaled in and got out on that. But the RSI was only at 70 there. Position trading is about scaling in and out of market movement. It's not, you have to have a set of rules that is exactly the same every time. You can do if you want to. If you want to just use 80-20 RSI extensions and put it on every single pair, do it. There's nothing wrong with that. It's a personal choice. Some people are just taking support resistance bounces. You do what you like. There's no one way to do this. Yeah, you get in how you want to get in. If something's pushed down really, really hard for 24 hours, it's likely to pull back. So you could just take that. But if you get in on that, you are long US dollar, you are short Canadian dollar. Yeah, so just watch your exposure. Don't overexpose yourself to the US dollar and the Canadian with another trade and another trade on a different instrument. So don't take any pound US dollar, pound CAD, euro US dollar, euro CAD, US dollar Swiss, CAD Swiss. Yeah. If you suddenly take all of those trades, you've got 4 or 5 exposures on the US dollar. You're already in the US dollar. So maybe take one more. But, you know, you can take whatever you want, but don't take it all. Remember what I was saying earlier, there's no right or wrong, and the market is fluid. You can't just go, I'm just going to do this. You have to change and do what you want, do what you feel. And you don't know if you're going to be right or wrong. I don't know if I'm right or wrong on any of these. Doesn't matter, does it? I'm prepared for whether I'm right. I'm prepared for whether I'm wrong. I'm just in it. And if it goes the wrong way, it goes the wrong way. I deal with it. Just have to wait longer, usually. Right, there you go. I'll leave it there. Anything you need, let me know. I'll be in Discord or Telegram. I'm back on Wednesday morning for a member stream, and then Wednesday afternoon we trade New York. And then after that, I'm off, packing off. All right. So anything you need, let me know. Other than that, I will see you next time. Have a good day.